Hey everyone, welcome to the 40th episode of Investing Kev. In today's episode, I want to talk about the fear about Chinese stocks delisting. This mainly stems from the news that DiDi, ticker DIDI, preparing to delist from the US stock exchange and move to Hong Kong. I want to go over the facts about that specific example and then provide my thoughts on the future of Chinese stocks in America such as Alibaba, JD, Pinduoduo, and many more. My channel is growing. We're 40 episodes in with over 325 subscribers, and I want to thank everyone for tuning in. I want to finish this year strong and to do my best in educating all of you so you can be an objective investor and to come across new stocks that you may not know much about. If you like my content, please give a thumbs up, subscribe, and let me know in the comments what you think. For full disclosure, this is not investment advice. I am not a financial professional. I am just sharing my thoughts. Always do your due diligence. Enough of this intro, let's get started. DiDi is officially seeking delisting from the US stock exchange and moving to Hong Kong 6 months after its IPO debut. I came out with a video back in July, episode 8, about this, and I said I wasn't too worried about it as I believed DiDi was going to comply. A few weeks ago, episode 33, I had this stock as one of the 5 undervalued Chinese stocks less than $10. Here we are. DiDi has not complied and is being asked to delist by the Chinese government. I will be the first to admit that I was wrong about them complying, but do I still believe in the stock? Yes, I do. It just won't be on the US stock exchange. There's also going to have to be things that DiDi does before I open up a position. I'll explain it in a little bit. What happened to DiDi is an outlier. That is unfair in my opinion to represent all Chinese stocks. DiDi was reckless and they were originally supposed to IPO in Hong Kong but decided to bypass that and go straight to the New York Stock Exchange while they still had outstanding cybersecurity issues. In the CNBC article, DiDi reportedly drew the ire of regulators when it pushed ahead with an IPO without resolving outstanding cybersecurity issues that the authorities wanted solved. DiDi is China's largest ride-hailing app and holds lots of data on travel routes and users. In my opinion, they were negligent and they need to be punished and be held accountable. China has come out and stated that data collection and privacy is a huge issue. Cybersecurity is a global issue that affects pretty much every single person out there. For DiDi to have leakage of data is not good for citizens domestically in China, but to anyone out there. In the same CNBC article, here's a quote. I think China has made it clear they no longer want technology companies listing over in the US markets because it brings them under the jurisdiction of the US regulators. And he also says, so our view has been that almost all of these US listed tech companies will relist either in Hong Kong or the mainland. Just because a stock delists from the US stock exchange does not mean it's the end of the world. And just because a stock has been trading over the counter does not mean it's a terrible stock. Tencent, ticker TCEHY, has been over the counter and has done well as one of the biggest companies in China. Nintendo is an over the counter stock and does well. And looking at this article back in April, these are 7 over the counter stocks to buy that would easily qualify for a major listing. You have Volkswagen, Daimler, Mitsubishi, Kawasaki, Nestle, and Bayer. These are some of the biggest automobile companies in the world, a massive pharmaceutical company, and a massive food and drink company in Nestle. There's a common thought that over-the-counter stocks are nothing but penny stocks or junk stocks. That may hold true for a lot of them, but at the end of the day, it doesn't matter whether they're OTC or in America. You need to do your due diligence and understand these companies. These are huge companies with a lot of information circulating about them. You have access to information about these major companies that may be listed over the counter. With all that being said, here's why I don't think most Chinese stocks will be delisted. This is an article that just came out yesterday. The SEC finalizes rule that allows it to delist foreign stocks for failure to meet audit requirements. On Thursday, the SEC adopted amendments to finalize rules to implement the Holding Foreign Companies Accountable Act, also known as HFCAA. The law was passed in 2020 after Chinese regulators repeatedly denied requests from the Public Company Accounting Oversight Board, also known as the PCAOB, which was created in 2002 to oversee the audits of public companies to inspect the audits of Chinese firms that list and trade in the United States. The law permits the SEC to ban companies from trading and to be delisted from exchanges if the PCAOB is unable to audit requested reports for 3 consecutive years. It also requires companies to declare whether they are owned or controlled by any foreign government. The law states that it has to be 3 consecutive years if the PCAOB is unable to audit requested reports. That sounds pretty lax to me. For example, what if a company produces the audits in year 2, then they've pushed off the 3 consecutive years starting next year? This was back on May 13th from the US-China Economic and Security Review Commission. As of May 5th, 2021, there were 248 Chinese companies listed on these US exchanges with a total market capitalization of 2.1 trillion. On October 2nd, 2020, when this table was last updated, there were 217 companies with a total market cap of 2.2 trillion. Obviously, right now with the sell-off in Chinese stocks, it's way less than 2.1 trillion, but that's still a massive amount of money in Chinese equities. At the end of the day, that hurts American investors. And from my perspective, I'm not worried about this because I believe Congress is beholden to Wall Street. What I mean by this is looking at this article back in April, Wall Street execs employees spent $2.9 billion on campaigns, lobbying during 2020 election. It states that the 2.9 billion outlay works out to almost $4 million a day throughout the cycle, according to the new report. The study combined lobbying and campaign contributions from 2019 through 2020. Part of the group's methodology focused on contributions and lobbying spending by those in the fire sector, which focuses on finance, insurance, and real estate industries. Year in and year out, this torrent of money gives Wall Street an outsized role in how we are governed, while driving and protecting policies that help this industry super wealthy amass even greater fortunes at the expense of the rest of us. From this article, the primary donors were from the finance, real estate, and insurance companies. These are some of the richest institutions and people in the world, and the rich will protect the rich every single time because they want their share of the pie. Do I believe that Wall Street is willing to give up over $1 trillion of American investor money in Chinese equities? I don't think so. A few weeks ago, Ray Dalio's Bridgewater is reportedly looking to raise $469 million in a new China fund. Dalio's Bridgewater Associates is the largest hedge fund in the world, with $223 billion in assets under management as of July 9th, filing with the US SEC. Over half, or nearly 59%, of those assets belong to non-US clients, according to the document. And just recently, Berkshire's Charlie Munger boosts long position in Alibaba. DiDi's delisting is because of their recklessness. Sure, other companies may be reckless and not comply. If that happens, then that happens, and I'll deal with that when the time comes. But at this point in time, these companies seem to be working to comply with both China and America. Chinese regulators also want to work towards a compromise with the SEC. It is unfair for me to look at DiDi and to automatically sell out thinking the same fate is going to happen with Alibaba, Baidu, JD, and any other Chinese stock. What will I do with DiDi? Well, I don't own any shares. I wanted to open up a position back in July, but I didn't because I had more important stocks to buy. I still believe in this company, but I need that trust to be built. I need them to successfully comply with Chinese regulators in regards to cybersecurity. If they once again don't do that, I don't want any part in this business. I thought back in July they would comply, and I was wrong. If they show that they have complied, I will consider initiating a position. I think with DiDi's delisting, they'll be out of the spotlight in Western media, which I believe that bodes well for them, just like Luckin Coffee. Luckin Coffee was penalized and delisted for defrauding investors. Luckin Coffee is now trading over the counter and is up 32.18% year to date. Both companies need to repair their image, just in different ways. It falls on these companies to determine their future and whether or not they're going to continue being negligent or actually do what's right. I need to see that from DiDi, and until then, it's high on my watch list, but right now I have better things to buy. There are good stocks and bad stocks in any market. You have Luckin Coffee and DiDi, and you can look at Nikola for their fraud. Due diligence matters, and even with due diligence, sometimes these companies still decide to take shortcuts and go against the law. What about other Chinese stocks? If Alibaba voluntarily delists, then I'm still holding. I'll be holding it from the Hong Kong Stock Exchange. I still know what this company is about, just like JD, Baidu, Pinduoduo, Neo, and many more. I believe in their stories, I believe in their future, and I'm willing to stomach the downturn now, believing that I will be rewarded someday. I'm not running from this. If anything, I welcome it. Back in 2017, when I was early into my investing career, I saw Alibaba at like $140, and I thought it was so expensive. This was before fractional shares were a thing alongside free trades. Here I am looking at it coming close to $110, and I wish I had more cash to invest. On Monday, I bought this stock at $130, and I thought it was a bargain. Now I don't have cash to buy at a better price at $112. So if you're in this for the long term, dollar cost averaging seems to be the way to go for the months to come. Right now, I don't think there's much a lot of these companies can do. They can come out and say, we are compliant, we have been compliant, and we will continue to work towards being always compliant. But the narratives have already been pushed. Do you really believe that the media is going to pick up on a company coming out saying that they're compliant compared to the clicks they're generating from the headlines right now? Do you believe retail investors will do their due diligence when they're on Reddit and Twitter and see these headlines on CNBC, Bloomberg, CNN, and Wall Street Journal? It is going to be a really rocky environment, but I have conviction in my holdings. That's all I got. Like I said, I'm in this for the years to come, and I got nothing to be scared of. No matter what, whether we're talking about Chinese stocks or US stocks or whatever in the stock market, you need to be objective. We all have to learn to be level-headed and to have conviction in the actions we take. If there's anything you ever learn from me on this channel, is that you need to do your due diligence and be objective. So what do you think? I'm interested to hear what you have to say. I'll likely do a video down the road on DiDi when it's on the Hong Kong Stock Exchange and see how it's doing. If you like this content, please give me a thumbs up so viewers can have an opportunity to come across my video and listen to my viewpoint on the subject. Also, this channel is growing, so help me out in growing it more by subscribing. Alright everyone, thank you for tuning in. It's always a pleasure, stay safe, and I'll see you all next time.